Hello, 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 everyone. Mike Arnold here, co-founder, Path Trading Partners, along with Bob Iaccino. Hope everything's going okay. YouTube's giving me technical problems today, but that's why we have multiple YouTube channels and we can watch it on other sites. So that's why you should always know where uh, we stream in case one isn't working. So, how is everyone doing? Hope everyone had a great evening. Prepared for April 1st, April Fools, one of my least favorite days of the year. Can't stand April Fools. And you won't find any April Fool jokes for me. So, welcome, welcome, welcome. If you're new here, please do consider subscribing, ringing the bell, and hitting that like button. Longer term viewers, leave some comments and like the videos. Non-farm payrolls also this morning. Good morning, Ken. Good morning, Amit. Good morning, Davey. Good morning, Wavy. This will be your last day at PTP. What's going? Be well, folks. You're now a GME ape. Is that better be a April Fool's joke? Although you know what, you chase some stock splits and everything else. There you go. All right, thanks for letting me know the video looks good. Good morning, Josh. That better be a joke, Wavy. So we did have non-farm payrolls come out. Slightly worse than expected. Unemployment rate, though, ticking down. Hourly earnings in line. Hourly earnings year over year, slight tick higher. Average weekly hours tick lower. So this is sort of a mixed message. We'll see if Bob can jump on. I texted him. And the participation rate actually ticking up a bit. I'm going to really be watching it coming out right now what Evan's speaking during this live stream. So it's over. All right, live stream's over. ISM manufacturing PMI at 9. So that's where we stand. FOMC, I didn't refresh it from earlier. Oh, by the way, we're literally right at positive versus negative gamma. So if we keep declining, you could see increased selling pressure, but if it rallies back, we go back to neutral and into slightly positive gamma mode. Let's just see now, back up to 50 basis point hike at a 0.75% probability, so 75%. Let's see. Oh no, we're stuck. That was an April Fool's, by the way, from Wavy. I'm never leaving. Oh boy. Morning, Sterling. Triple H. Welcome, Options 22. What do you think about seasonality? I see that April is one of the more bullish months of the year on average. Traditionally, it is, but you know, it's not every year. So that's where we've already had the major rip your face off rally. Good day, good day, good day. So we've already had this rip your face off rally. Can it continue? It sure can. It could. Right now, you can barely see the bar, though. I was watching this. One of the plays I hate is the first breakdown, especially in pre-market hours from flags like this. Coming up, you see in the 1 hour rotation zone breaking down. I'm going to watch for a retest and another rollover play. That's my preferred thing, especially when something breaks out pre-market, because I want it to really sustain during regular market hours. That's one of the things that you might want to investigate for yourself when something breaks out during slow conditions or breaks down. I always watch for the retest play. That's my bread and butter play. And the retest area right now would be right around 50, 45, 47, 45, 48. It's an area right in here with the declining 1 hour rotation zone. What would shift that? Starting to get above that 1 hour rotation zone and back above about 45, 52. So right in here. Then I would be definitely watching for a play back to the upside. Remember, on the daily, we came down pretty much finishing on the rotation zone. And so we shall have to see how it turns out today. I don't have major sell signals unless we break down from this little flag and get below yesterday's low. Then I will watch. It would not be a major sell signal, but we could run down to 44.80 with the 200. Below there, the next major support is about 44.57 to 44.61. That's what I'm keying off of this morning. Let's see if we did get back above the channel. Keep in mind this, we get above this 45.52 area, you're running into the 4 hour rotation zone again. And there's overhead resistance, although we do have some of a clear path move from the afternoon sell-off. So where do you start getting into the clear path? I'd start watching again for about 45.55 into this area. So that's the thing. That's the only gotcha with the upside move. If we did get a fair amount of buying pressure and above this channel, you could see a quick little pop up to about 45.75. I don't have any fantastic signals right now. There's nothing great going on. There was a little very aggressive buy pattern last night. Nothing I did with it because we're against the daily rotation zone. I really need to get a longer term signal to see if we shift back to bearish mode or stay in slightly bullish to neutral mode. Let's see, where do we sit? Morning, Daniel. Morning, Lauren. Wow, how are we green? What? What do you mean, how are we green? Oh, here's Bob. Hold on. Here, I can get Bob on. Let me switch back now that Bob's dialing in. We got to get the important person on. Get rid of me. Get me out of here. Here we go. All right, we have everyone came to see Bob. Here we go.
I don't know if that's the case.
I think it. I'm just going to sit here and sip my coffee and listen to you.
Oh, I don't have anything to say. I'll tell you what, there's no good news in that number for the Fed. That's my first take on it as I was looking through it is that even though the headline number missed a little bit, there's no good news for that number in the Fed. The average hours worked, I believe, ticked down.
Yeah,
but
ticked down slightly.
Wages ticked up. And they, in my quick back of the envelope math, didn't tick up enough to improve the real wages situation. So we still have an inflation issue within this number. We have a drop in the unemployment rate and a rise in the labor force participation rate. So you can't explain it away by saying maybe the number's down because participation dropped. It didn't, it rose. So that does mean more people going to work on a relative basis, at least in that number. I didn't look at the U6. People have been pointing to the jobless claims numbers dropping quite a bit. And I don't think that matters as much as this number does because jobless claims is about people exhausting their benefits right now, more so than people being at work. This number relates more to people being at work. So these figures show that people are going back to work. Largely likely in the service sectors. Manufacturing did go up by 8,000 jobs versus the expectation. When you look at it, the manufacturing jobs specifically, what is going on here? Oh, I'm sorry. Hang on. I got a wrong setting here. Anyway, they matched last month's, but last month's was revised up. So still good news overall for the manufacturing sector. But these things only matter in the context of what the Fed might do. And these numbers don't tell you that the Fed should go 25. They tell you that the Fed should still be looking at 50. As Mike pointed out in yesterday's live stream, the PCE numbers, the inflation numbers, which really have become this current era's non-farm payrolls report, where it's the most important number. Those particular numbers were very strong, even though the headline missed. And with this those numbers did not have the invasion in them. Now, you wouldn't expect the invasion to affect regional payrolls numbers. They wouldn't. All they would do is you could look into these numbers and say, okay, are wages moderating? Is that wages are the largest factor in the price of consumer end goods and consumer goods. So wages, you would like to see wages moderating to maybe offset the input costs that are a problem for manufacturers and for service providers right now, and they're not doing that. So wages are not moderating. Hours worked being cut shows that wages are a stress. Okay, so when you look at the average work week, it was the work week that fell, right, Mike?
The average weekly
hours.
Yep.
Yeah, that shows that people are giving people less hours to try and offset the higher wages. And that's not really a big drop from the expectation in that hourly work week. And excuse me, the forecast and the previous were the same. So that kind of remains the same. And the average hourly earnings is a big jump from last month, both month over month and year over year. So that's my take. There's no good news in here for the Fed at all. The Fed still has to point more towards 50 in the next meeting than leaning back down 25. We'll see what happens with the Mike. I see you put up the Fed watch tool from the CME group. It's likely not adjusted yet to these non-farm payrolls number. I think it resets hourly.
It bounced up. Oh yeah, it does. But it bounced. I don't know if it resets on the hour, but it bounced up early. It's there.
To 50 basis points, you mean?
Yeah, it was at 75% for 50. I'm expecting it to go up even higher. We have
Yeah, I think it's going to go up higher after this particular set of numbers.
before anybody asks. Before anybody asks, yes, the yield curve is back, or the 210s. Let me cite which yield curve because we have many of them, but the 210s back below zero. And the yield.
It was at zero pre non-farm.
Yeah. And now it's back below zero. And the 10 years still, now the yield's going back up. The main thing with we had that double bottom on the 4 hour into the 4 hour rotation zone, which is why when you're going against the key rotation zone, you always watch it, but hitting the first and second target and rotating back down. So that's really what I'm focused on. When you mentioned I don't know, it was maybe a week or two ago, the difference between yield curve inverting with strengthening treasuries versus weakening treasuries. Can you recap that?
Yeah, so you get bear market steepeners, bull market steepeners, bear market flatteners, and bull market flatteners. What we've got right now is a bear market flattener because yields are falling and the curve is flattening. The reason that's bad is because that's a weakening economy indicator. So you've got yields going lower. That means people think that inflation is going to be under control down the road because A, the Fed is hiking, and B, the economy is likely slowing. And a lot of this particular bout, I would probably say 2.3% of it, okay, and again, that's back of the envelope, is from supply chain, not from demand. And the Fed can't control supply chain issues. They can only kind of try and weaken demand. And it's a trickle down weakening, right? You raise interest rates, so it raises a little bit of the interest on credit cards. It raises adjustable mortgages, any adjustable rate financing that companies might have. It raises that a little bit. And that kind of slows demand because people have less money to spend on other things because their interest rates are rising and money is less easy. It should theoretically also slow the housing market a little bit, which will slow sales at Home Depot and Lowe's, et cetera. So it's a trickle down effect. A lot of people don't believe in trickle down economics. They do believe in this part of trickle down supply. So because it's forced by a government agency.
Okay. So any other Amit, given all the headwinds, inflation, rate hikes, no QE, war, supply chain disruptions, the market is quite resilient.
Yeah, so remember, it's not linear, Amit. Assets respond positively to inflation, not negatively. Okay, so real estate, stocks, they respond positively. You need look no further than the performance of energy companies when crude oil prices are rising. Okay, so their input price is inflating. We went over this a little while back. Crude oil companies' profits are at records because the prices are rising along with the price of crude oil, and that relationship is built in. Yet their other prices are not rising as fast. Inputs such as labor, delivery starting to rise now. So their profits go higher, but their margins shrink. Okay, because you're getting a margin on a larger number. So it's not linear. Stocks are actually a good hedge against inflation. It's down the road when the economy actually slows that it hits equities. And as you saw in the non-farm payrolls report, we're not seeing that yet. I would argue the economy is slowing. We showed that composite PMI chart yesterday. But if you look at where the composite PMI actually is, it's still in expansion territory. So even though the rate of growth of the economy is, in my opinion, slowing. It's not negative yet. So that's when you're going to start to look for stocks go into effect. I mean, you're still, again, well above 50. You're almost to 60 still, even though the rate of change is in downward trajectory. 50 on the PMI figures, the ISM figures, is the fulcrum between expansion and contraction. You get below 50, then that means the Institute of Supply Manager and the Purchasing Managers Index are in contraction territory. So always keep that in mind, Amit. Inflation, not a negative to stocks. Rate hikes means a strong economy. If you look at the last 11 rate hike cycles, stocks went up in 8 of those. Okay, and that means from the beginning of the cycle to the end of the cycle. The effect of rate hikes takes anywhere from 6 to 12 months to actually hit the economy. So don't be looking for stocks to fall because of inflation. Don't be looking for stocks to fall because of rate hikes. No QE. That's an interest rate scenario. So the Fed is no longer buying bonds. That's starting to raise prices specifically on mortgages. That, again, is a lag. There'll be a lagged effect there. War, I mean, I agree. If we get involved in it, if somehow NATO troops get involved in it, they'll probably hit stock markets. But again, imagine what war does. It makes stocks like Raytheon, Lockheed Martin start to have another customer, a new customer, a rebuild of stockpiles, right? Supply chain disruption, agree. Stocks are resilient in the face of supply chain disruption. Totally agree with that. So you have to have these things reach their sort of second derivative, meaning inflation has to hit the consumer. Rate hikes have to hit the consumer. No QE has to raise prices on who? The end consumer and some of the firms using credit lines to pay bills. And then it hits the stock market after that.
Sterling says, being in a career where I'm tied to lending, there will be a tremendous consumer credit problem soon. If inflation is not brought under control, people don't have the disposable income to handle this.
So Cameron Dawson, who she sent me her, Mike, I'll send you this if you're interested in reading it. She has a 31-page report. And in that 31-page report, it basically shows evidence of savings being gone for the middle to lower end consumer. For the wealthy, it's still there. But savings is now gone, speaking right to Sterling's point. Okay, that as inflation hits, consumer credit, they're going to start putting more on credit cards. I would argue they're doing that already. And then that's going to shrink their spending. So again, it's like the second derivatives.
Which, given all this being said, is why I can only trade things technically, because I'm not smart enough to figure out what the market's going to do at any given time based off all these inputs.
Everything I've said is correct. Where does that put prices? I don't know. I can't do that math. Where does that say the equities are supposed to be? Well, I don't know. We're not even at the point where these things should affect equities yet. So I don't know. Where's the tipping point where people that have more money to move the markets than us start selling the market? I don't know where that point is. So we rely on price action and charts to tell us when that's sort of happened.
Yeah, that's the default thing. Before we wrap this up, I mean, we've got a little potential double bottom in crude, but any thoughts now with the continued crude pullback?
I love buying crude. Just I need a price action signal, and that double top or double bottom may be the reason. I love buying crude here. 2 reasons. So 1 million barrels a day for 180 days. That's 6 months. Okay. There's last I looked, there were 707 million barrels in the SPI. Some people say that's at 727 now because they built it up knowing they were going to need to release it. So maybe they did. I don't know. But if you subtract 1 million barrels a day for 180 days, that leaves us with about 550 approximately. If you take the higher number, leaves us with about 550 million barrels in the Strategic Petroleum Reserve. Now, the Energy Secretary on Bloomberg this morning, Amos Hochstein, I think is his name, said that now they're going to build it back up at lower prices, right? So they're selling it at higher prices. They're going to build it back up at lower prices. Okay, fine. The Energy Department gets an influx of cash, but this puts a floor in crude oil going forward. Because at the same time that the U.S. is releasing 1 million barrels a day, at some point they're going to be buying anywhere from 750 million barrels to 1 million barrels a day down the road, which puts a floor under crude oil. I don't know where that price is, but likely it's somewhere after the conflict dies down or ends. It's Russia, Ukraine. And probably they are, okay, conspiracy theory now, aluminum hats. They're going to try and hit oil companies. They've got a meeting next week. Some of it will be televised, right? So they'll televise where Elizabeth Warren is calling them robber barons. And then they'll turn the cameras off and they'll say, look, guys, pump a little as quick as you can, because we're going to be there to buy to replenish the SPR down the road when it gets to about $40 or $50 or even $60. So it puts a floor under crude oil in the future. Now, obviously, none of that matters where I'm going to buy crude oil now. Mike's got to tell me where that is. But I love the upside of crude oil for the medium term.
Okay, Sterling says, take a look at Palladium. Don't know why it's up 3%. I don't know either why it's up 3%, but it's up 3%. Looks like a
it's a rare earth metal. It's a rare earth metal, right?
Yeah. I mean,
and a lot of that stuff comes from Russia.
Yep, you do have an inverse head and shoulders. So
Ukraine hit a weapons depot on Russian soil today. Does that sound like de-escalation to you guys?
No, but they said there were peace talks and they were progressing, Bob. That's why the market rallied.
Yeah, they're progressing. That's fine.
They'll always be progressing until they're not. Yes, that is valid, Sterling. Completely. 2434, 2503. I just go to 2500 on there, and those are the two highest probability targets. And let's just take a look at because you also do not ignore that first target. You are still against the daily rotation zone, but it is flattening. So this could be just another recovery rally, but it is a completely valid, so it still can be completely traded. Nothing's invalid on that.
Okay, so the top palladium producing countries in the world as of 2017: Russia, 81 million metric tons; South Africa, 78; Canada, 19; United States, 13. So you go from 81 million metric tons to 78 to 19. So Russia is by far the largest producer. South Africa is second, but could nowhere make up the 81 million metric tons that Russia produces. They're already at 78. So if you have a disruption in supply there, it just makes sense that palladium would go up. But, that doesn't mean it continues to go up. I don't know what ratio. I don't know if 3% is the right number. I don't know.
One other quick final question before we go into the open, and I have to get going. If we see margin compression, would it show up in Q1 earnings or possible much later Q2 or Q3?
Q2 to Q3. It's not going to show up in Q1. Remember, the invasion happened really at the end of Q1. What happened, like March 11th or so, somewhere around there? So it would literally be 1/2 to 2/3 of 1 month in a 3-month quarter. So Q2 is where you'd look for it. They'll start warning about it in Q1, though, so watch for that.
Okay, so that's what we focus on with Q1 earnings when they come up shortly. There you go. Well, I'll let you go for the open, Bob. Thank you for being
cheers,
here.
Guys.
And I will talk to everyone later. Okay, we'll have a session this afternoon. It might be a classroom rant session, and then we'll just go over the normal market things this weekend. So there you go. So if you want to join a rant session or something else, or what Mike thinks about something, like it really matters what I think about it, here you go. I'll let Bob know for the clarification. You're welcome, Wavy. You're welcome, Ramsey Fall. You are welcome, Eric. You're welcome, Sterling. Again, trade well. If you don't have a trade, then don't force a trade today. Let's just peek at Tesla. Looks like it's going to be a slight gap up. I'm going to be watching for the play. Oh, does somebody know the delivery, when the expected Tesla delivery numbers are coming out? If somebody's still here, do you know when that is? just let me know, or put it in Discord if you do know. Again, if we get that gap up and roll over, if we start breaking below, especially about 1072.75, I'm going to watch for further price action. Probably Sunday or today after, I think. We have Saturday. We have April 2nd, which would be Saturday. We have today after hours and probably Saturday. So I'm going with Saturday. All right. So remember that with your stops or your positioning. I think they're going to miss, but we shall see. We shall see. That is the gamble moving forward. I'm just watching again for if we turn around and fill this very small gap. Remember, it's yesterday's close. I'm watching for a lower price action. You have a lot of overhead resistance. Keep that in mind also. And with that, have a great day trading. I will talk to everyone later. Bye for now.